Welcome back, everybody. And yep, it's another Saturday. Can you believe it's the first week in December? I cannot believe it. Anyway, super exciting. There's a lot of things that are happening. First, I need to do a quick shout out to Brian Graves, who had his birthday yesterday, my business partner that I bought out. 97 years old. Happy birthday, Brian. And one of our team members, Albert Kwan, his birthday was yesterday also. Again, happy birthday, Albert. Again, amazing knowing you guys, and it has been a privilege so far. Anyway, with that being said, what the heck is going on with our market? What did November do? And based on some of the crazy media out there and other reports that were going on, what did November actually do? And then what does that look like for the rest of the year? And well, into Q1, what the heck are the Feds doing? And are they going to raise rates again, which is going to have a commercial impact, which is, your credit cards. Oh, for those people that did not refinance and had 7 and 5 year arms, and your arm expired, meaning that it becomes adjustable, most of you went up 5% and probably had a little bit of a heart attack. Or maybe you didn't realize that you went up 5%. And you're going, what? I need to go look. And then you're going to be like, holy smokes. So there are options for you. If you need those, hey, leave us a message. We'll get you a couple of options out there, no cost refis to buy you some time, albeit rates have come down, and we'll go into that a little bit more. So with that being said, let's take a look at what the heck. So we have some national news. Home inventory finally showing some signs of life in November. And then, of course, the FHFA, and that's the Federal Housing Financing Agency. They are raising loan limits again so that it conforms to the median income. Now, as you saw, about 766,000 is going to be the national number, plus or minus. For Pierce and Snohomish County, probably pretty close to 1.1 million. Might be Pierce, but more than likely, at least Snohomish and King County will bump to about 1.1 million, which that cracks me up. That's an FHA loan number. But anyway, with that being said, we then look at what is going on. What's happening with the numbers? Where are we going? Are we seeing more sales? Are we seeing less sales? Are people bailing? Let's go through that right now. So first, let's pull up that screen and let's talk a little bit about inventory. On the national level, Zillow is predicting some easing of inventory, as far as affordability for 2024. And part of that is because they've seen about a 7% increase on a national level as far as new homes coming on market. That's a big deal because for us, and this is why it's important to like and subscribe and share this video. For us, it's a little bit different. We're still struggling on inventory. So when we take a look at what is going on, and if I blow this up, not in the literal sense, you can see here on our chart, the two arrows show where we were at last year. And the blue line, as you can see, is inventory, and that is a normal dip. Same thing with pending sales. And then, of course, you see them coming back up. And you go over to the far right-hand side, you can see that very same thing. Now, what's important about that when you take a look at the normal cycle is that as we head into the November, December, that has also been, at least in the last 4 years technical, interest rate driven. Now, last year, our interest rates went way down, or I should say went lower and sparked a lot of activity. And that is the expectation here, since we again have started to see our interest rates lower, and we're going to see a little bit of a dip. I'm going to show you a video here in just a little bit and walk you through that, right? So if we take a look at our running 7-day average here, look, we had 581 homes coming on market. Scroll down, we take a look, we have 774 pended, and then 700 sold. And then, of course, when we come back up, we can see that there's 117 that came back on market and 446 that actually did a price reduction. What is important about this is to understand that as we're looking at our metrics each and every week, you can still see that we're seeing more pended or more homes going from active to pending status than there are coming on market. And that has been a consistent trend, for 3 years now, except for 2 weeks, which was once in October and then once in, I believe it was February, where the number of homes on market exceeded, actually, I think it was actually April, exceeded the number of homes that went pending. Only happened on 2 7-day running average weeks. The rest of it, the pending sales have already been there. In fact, when we take a look at our next chart, super interesting. Take a look at this. So when we take a look at our year to date, right? Here we go. We can see that our numbers now are super close. We don't have that 20% disparity. Still the same with the number of homes on market, number of homes sold, and the number of homes that actually went pending. Now, remember, when we take a look at month over month, just November, right, 2022 and 2023, listen, you can see 20% off. But look, our pending sales were up 2.2% for the same month year over year. That is a big number. That's a big number because our interest rates are almost three quarters of a percent higher. That's about $170, $180 worth of buying power-ish, depending on the median price, the sales price that we're seeing today. Now, when we take a look at those numbers, okay, so understand, we are down 25,332 homes. We're down less year over year. We have that many homes less. Even active, you saw that we were normally about 20% inventory different, right? Or about 1,800, 2,000 homes. But now, heck, we're only a couple of homes different. When we talk about pendeds are down 13,385 as of yesterday, single family only, okay? But solds are down 17,523. 17,500 homes sold less. And that's why you're seeing in the media, oh my gosh, sales have really slowed down. Well, yeah, you have 25,000 less homes available. It's not that we don't have buyers. I mean, heck, when you looked at it, you still saw that we had more pended sales than new coming on market. We still have a pent-up buyer demand. And in fact, a lot of buyers are acclimating or have acclimated to the higher interest rates because, well, you don't look in the rearview mirror. You don't look backwards unless that's where you're going to go. Look, we're not going to see the fives again. I don't predict that. Maybe the mid to low sixes, and we're going to start heading in that trend. Maybe high fives on an occasional blurb, but I don't foresee that unless we see a true pivot. The Feds probably are not going to raise rates 25 basis points or 0.25% for a couple of reasons. One, corporate bankruptcies just blossomed, okay? That's going to be a big indicator. Plus, when they take a look at the consumption, the consumption number, I forgot what it was just called, just absolutely blank. But anyway, the number that the Feds really monitor when they take a look at inflation actually came down to 3%, which was better than expected. That's why we have been seeing some really good mortgage rates as investors are looking at and finding a little safe territory, and that the Fed's not going to do something crazy again. Not saying they won't, just less likely, which is going to be super important because if they pivot, meaning that they start dropping rate, that's a pivot that will drive us into a recession. It's a given. That means mortgage interest rates historically have always gone down, which then the buyers come out and then more home sales, and then home sales actually start going in an upward trend where we have been relatively flat. We're between 1.4 and 4%, depending on the area. Kind of as predicted. Go back a year ago, listen to what we said, cap out about 4%. So we're about 1.4, 1.5 to 4%-ish, depending on area. All right, let's move on. When we take a look at new construction, so let's pop over to new construction. New construction, super interesting because, again, those numbers are holding very, very firm, okay? Now, when we take a look at these as a blow-up, not in the literal sense, year over year, look, we're 48 homes off as total inventory year over year, 277 new on market, 297 sold. But look at this, still 1,337 homes. We look at it same month, year over year, all right? You can see that our inventory has only been off 216 homes, 15 homes new on market different, 45-ish unsold, and we have 57 more homes that have actually gone pended over what we saw last year. Okay, so November has shaken out to be pretty good. Our numbers pretty much on par. Our biggest problem, not enough inventory coming online. It's been giving us price support. So, it's that double-edged sword, as they say, because if we have more inventory, like some of the areas that have, like we have 2.2 months of inventory right now. We've been inching up just a little bit, but coming back down based on solds. Because our solds are so low, it makes the number of months of inventory look a little bit better. Unlike some of the other areas that have, say, like 4 months, 3.5 months of inventory, they've actually seen some depreciation, 5, 7, 8% depreciation in just single family home sale pricing. Okay. Remember, it's like a stock. Okay. Your home doesn't go down in value unless you sell it today, but ours has actually been doing very, very well. Let's talk a little bit about that after we talk about the foreclosures. Now, what's interesting about the foreclosures? All right. So, funny enough, when we take a look at foreclosures and we blow this up a little bit, actually, let me put that back down where it was. All right. Here's the thing. As of yesterday, it said we have 72 homes that were foreclosures and available for sale. And I thought, I wonder how many of those homes belong on the wall of shame, meaning that they're actually not foreclosures. They're just agents that didn't do their job and haven't done their job correctly, since some of them have been on the market for up to 45 days. Yikes. Anyway, that ended up being 12. So when we take a look at this a little bit closer, let's pop up here, you can see year to date, it's actually not 84.6, but 65%, because there's 12 less, which is only 60 homes. Sure, all of our other numbers are just a teeny bit higher, not by much, just peanuts, but that meant that there were 12 homes just on the few that I looked at that, well, they weren't bank owned. They were normal seller owned. In fact, one agent owned his own and a couple of builder homes, which is super, super sad. Why is that super sad? Because they're not really getting the exposure that they want because they're showing as a bank-owned property. So in actuality, our bank-owned numbers as far as total inventory year to date is only up 65%. And because we are dealing with such tiny little numbers, it's really inconsequential. So as we move on, let's take a little bit more about what's going on with the market, because we talked about, hey, here's what's going on with our inventory. Here's what new construction is doing. And now we've got what the REOs are doing, which haven't hit yet. Now, understand, as of November 30th, the CARES Act, that's an acronym, that was protecting what we call serious delinquencies, 90 days or more, that protection ended. So we are going to see a little bit of an uptick on notice of defaults. We don't see that. That's private. Notice of trustee sales. We're probably going to see a little bit of an uptick in notice of trustee sales. Totally normal. And that I would expect to continue to ramp up ever so gradually over the next 6 months. And we'll evaluate that and keep you guys abreast each and every week. Now, as we come over, let's take a look at this slide. Here's something that is super important, right? All right. So when we take a look at the year over year, both now and in the same month of November, so we're talking apples to apples, right? Let's pull this up. So we have year over year, top line here, that is the days on market. And as you can see, we're up almost double. And then, of course, we're down 3% as far as the list to sales price. But look at November. Look, there's no change. Year over year, it's still 38 days, okay? And when we take a look at the list to sales price, we're actually 2% higher in November this year than we were at last year. And that is a super important, metric to pay attention, because it lets us know in real time, really, how did we compare? Well, we actually did better last year or this year than we did last year, both in the pending sales and, well, to a degree, especially new construction, but our days on market didn't change and our list to sales price improved, and we aren't necessarily going down in home values. That median sales price is coming down, but as interest rates go up, and we're going to see that change. How does that change? Well, when we take a look at our next chart here, and we take a look at interest rates, so let's blow this one back up. So we have our 30-year fixed mortgage at 7.09, which is really actually quite awesome. Freddie Mac showed it at 7.22. Super, super important. Why? Because we have been on a downward trend for quite a while. That downward trend, as we take a look at our next slide, when we just take a look at what's going on. So when we take a look at the actual video itself, look, so this is October of last year, November, and you can see 6.61, 6.58, 6.5 on December 1. Now, as we roll through, we can see that, this year we peaked out 7.9, 7.6. We've been dropping back down. And as you can see, even over last year, it's a normal cycle trend that we see coming down. That is super important because as we are taking a look at what to expect in December and January, we are expecting those rates to come back down, especially if the Feds don't increase rate. It is entirely possible we're going to see the mid to high sixes for mortgage rates by the time we hit the end of the year, even in Q1, as long as those performance metrics on inflation continue in a positive direction. And of course, that the Feds don't increase rate, which is very cautious for them since we have so much commercial inventory that needs to refinance. Only about $1 trillion. Anyway, with that, make sure you like and subscribe, okay? Share and ask questions because we love to answer questions for you. And the super cool part about this, let's move that back over. Smash that subscribe button. Share it with everybody that you know. Like the video. It just helps others to see it. There's no selling here, so hopefully you found this informative, and we truly appreciate it. In the meantime, have a very Merry Christmas. I wish you guys all the best, and I will see you on the next video. Take care.